Hello everybody. Welcome to another webinar here at FCI Markets. My name is Justin Paolini, Head of Trader Development, and today we are going to talk about the break and retest trading strategy. Before we start, let's just go through the risk warning. Our investments, products, and services are not suitable for everyone. It is possible to lose all or part of your investment. For leveraged products trading, it is possible to lose more than your deposit. Trading on margin carries a higher level of risk, and it is possible to be required to deposit additional funds. You should not invest money you cannot afford to lose. And with that said and done, our objectives here at FCI Markets. We are here to give you the tools to become consistent traders and help you simplify your trading habits. We want to train you because we have office space and we have funding capacity, so we can help you move from the retail side to the professional side of the business and become professional traders. This is our funding page, and you can find it at fci-markets.co.uk/funding. This is where you have all the details on how to open a funded account and the qualification process. But usually I suggest just getting in touch and showing us your track record, and then we can establish the relationship. I wanted to let you know that we also have a free course. You can sign up at fci-markets.co.uk/promotion/free course. We have put 15 years of trading experience into this course. So if you're just starting out or you haven't reached consistency yet, then I would definitely suggest just subscribing to this course. It's delivered via email, and you can study at your own pace. I think there are a few things in there that you won't find elsewhere on the web. Finally, if you're really serious about becoming a professional trader and getting funded as quickly as possible, then the pathway I suggest is our academy. I teach in our academy, and there's a combination of video lessons, live webinars with Q&A sessions, and interaction via email. So it's an interactive environment where we can help you, get up to speed. So the break and retest strategy. Let me just check here how many people are in the room. Okay, a few people in the room, so we can continue. I just wanted to let you know that if you do have any questions, just let me know. Raise your hand. You should have the chat possibility. And if for some reason my internet conks out or you can't hear me, once again, raise your hand and let me know. So break and retest strategy, just as the name says, it's very simple. The price breaks through something, and then it goes back down to retest, and that's where we get interested. The objectives of this strategy are very simple. The first thing to keep in mind is that we're trying to simplify our trading habits, because most aspiring traders, most retail traders overcomplicate their lives. So we've got to simplify things. And what we're doing is we are adopting a model only based on market structure. So, the setups, the levels, we are not using indicators to identify them. We're not using anything else. We're just observing how the market has traded, and we are basing our future participation off of the recent past, because the market is generated by the interaction of buyers and sellers. And where we have had strong departure, so either like strong selling or strong buying in the recent past, it's probable that the markets will act in the same way, unless you break structure. So unless there's like a news piece or there's some fundamental data that changes the nature of the market structure. But otherwise, we can expect the market to react in a fairly consistent manner, the way it has in the recent past. The levels that I've used and that I'll be showing you are based on 4-hour charts and 1-hour charts. I would strongly suggest to not use anything lower than a 1-hour chart to identify, your key levels and zones, because in my personal experience, I'm talking about, 10 years experience now, looking at the markets in a similar way, it's more hit and miss. They're less robust. At the same time, I didn't put the daily in here because the daily chart has undergone a few changes. I've noticed that the markets now look at more detail. A daily chart will break through a level and it really won't retest it. It will just, especially when the trends are really, really strong, the daily chart will break through a level and it will just continue for days on end. And so what we need to do is we need to learn to use these smaller time frame levels in line with the broader trend. Okay, so that's why I focused on the 4-hour and 1-hour levels. Then this thing is 100% rules based. Okay, there really is minimal discretion available. Okay, we have a trend filter. Now for the trend filter, I would just suggest using a 50 simple moving average slope on your primary time frame. So whether if you're like a swing trader or you're looking for lower frequency or you're trading around a day job, sticking to the 4-hour is probably the better bet. And so you would put your 50 simple moving average on the 4-hour chart. If you have more time to sit in front of your charts, then, or if you're right now with the COVID, you're working from home and you have multiple screens, you can keep one screen on your pre-identified pairs. You can just drill down to a 1-hour. Okay, so you have both your 4-hour levels and your 1-hour levels on the same chart, and you're observing it from that time frame. The objectives that you have, so the multi-day versus the intraday, depends on your job, and it depends on the time availability that you have to follow the markets. Okay, that's how you actually decide on what to do and what time frame to choose. So the trend filter is very simple. You don't need to overcomplicate it. The levels are self-explanatory, and we will see them shortly, but basically, you're looking for wick rejections in the recent past. The setup that I'll be showing you is something that we teach. We actually put it inside the free course that I showed you before, that free course that's delivered via email. It's basically like an inside bar. So the market goes up to your pre-identified level. You wait for the market to provide an inside candle. Okay, and that's your trigger. It's a very simple trigger, the break through the inside candle. And then the management. And the management, the rules are all inside our free course. There are 3 components to the trade management. You're looking for an exhaustion of momentum, either that or you're starting to see reversal candles, or the thing can break above a moving average. But I'm keeping the management in the actual examples that I went through. I kept the management very, very simple, and I just used reversal candles and the loss of momentum. So again, very simple. And I guess what I'm trying to say here is that if you keep your rules extremely simple and efficient, and you don't lose track of what you're actually trying to do, okay, which is play off of key levels, you can become a consistent trader and generate a track record. You don't need anything else. Okay, you really need to believe that it is possible to trade with such a simple system. And because many people believe that they need something more complex, or that we know something, that us professional traders on the other side, we have some kind of inside information that we're using, or we know which levels will hold or which levels won't. That's just not the case. Okay, the market is an infinitely complex game, and that's why even the smartest people, the best hedge funds, the best quants, they haven't cracked it, because it's continuously evolving and it's impossible to really predict the future. So what we need to do is have a very simple system and not get attached to every single trade. Okay, if you want to identify the proper way to identify any flaws, or to make sure that you're doing things in the right way and that you're not screwing up, is to take samples of trades. So take 20 or 30 trades at a time. And over those 20 or 30 trades, you maintain the rules fixed, and you execute and manage your trades in exactly the same way. That way you have consistency in your statistics. Then you can analyze them. So after 20 or 30 trades, you take a look and you say, okay, well, I executed them well. I didn't make any execution errors. So what are the results saying? And from there, you can make any tweaks if you need to. But doing this after 1 or 2 or 3 trades, even 5 or 10, it's useless. It's random. Okay, you need to take a larger sample size. So, I have one other little nugget that I don't think you'll find on the internet, because when we talk about breakout and retest, even YouTube nowadays, it's full of these youngsters who are, are showing just how great they are, and how easy it is to trade and this and that. After years of experience, remember that there are old traders and there are bold traders, but you won't find any old, bold traders. So I'm 36 and I feel kind of young, but I'm definitely not bold any longer. After 15 years in the markets, I'm over that. So, and hopefully you survive 15 years as well, and more than that, and you realize, what exactly the angle I'm coming from. So what does experience teach us about levels and about how to play these things, and where most people just go wrong? You need to trade the levels as the market is producing them, because you have to trade the levels in line with momentum, with current momentum. Okay, so where the market is going today, and today, if it's not today, then it must be this week. Because if you start looking at the past, if you start going onto charts and drawing random lines through a lot of price action on the daily charts or the 4-hour, whatever it is, you lose significance, because the market is forward looking. It's not backward looking. The market is always forward looking. So the levels that are in play today and this week may not be the levels that were in play last week, or a couple of weeks ago, let alone last month or last year. So, if you like your levels, if you like drawing levels in any particular way, then at least wait until your old levels stack up, coincide with these new levels that are being designed and printed by the market, like in the past couple of days. Okay, you need to make sure the current momentum in the market is actually reacting and respecting those levels. So and what I did in the actual test that I did, I didn't have any preconceived levels or ideas, and I'll show you soon. I'll just shortly in the next couple of slides, we'll start looking at the examples. The prior day and prior week levels really are the most important. Okay, so that's why this is an example of Aussie dollar. This is the 4-hour chart. I just took a snapshot this morning. Why is this level important? 77.36. I would trade that, but I wouldn't trade 76.40, because number one, the most recent level that's being traded, and you can see it, right? You can see it visually. Even this week, after the breakdown, the market tested it from below, it rejected it, but then it broke above, and now it's testing from above. Okay, so this 77.30s are in play, but I wouldn't look for longs if we get back down to 76.40, because by the time we get down there, it would take a break of this level, and we'd be negative not just on today, but on the week. Momentum would actually be shifting to the downside. So we would actually be fading. We would be fighting momentum and not trading in line with current momentum. So if we were to get down there, let's say today, for some reason, like Biden's fiscal stimulus seriously disappoints or something like that, the market shoots down, I would actually be looking for a break of 76.40 and then a retest, instead of looking for longs. Okay, this is the detail. This is this is actually quite important, but it's a detail you gain with experience. The levels may still be traded, even if they're coming from 2 or 3 weeks ago or even longer than that, but the current momentum will decide, what you should be doing there. And yeah, and that's why you can't just create levels on your chart and expect the market to react at them the same way it did in the past. You have to follow current momentum. Okay, don't fade. So, what exactly did I do to prepare this webinar? For the first time in my life, I downloaded a demo of ForexTester. Okay, and to be honest, I actually found it quite useful. I was surprised. I used the strategy that I'm describing today on the random price history. Now, it ended up being April 2018 on the euro. I didn't choose that. I didn't know it was going to be the euro. I didn't know it was going to be 2018. The demo was very limited, so it just started from there. And what I want to show you is that even though I was trading in real time on this demo, I didn't know the levels that were being formed. I didn't know what sentiment was. I didn't have any other information, and that's why I was so surprised, because the model really did a good job, even though I knew nothing else about the markets. Like, I don't even remember what sentiment was like, in 2018. So it goes to show that number one, I guess tools like ForexTester can actually be helpful, but number two, the simple strategy that we're going to see is useful even if you don't pay too much attention to the news, even though you should. So here are the trades. This is the actual start of the testing. Okay, so it starts on the 1st of April 2018, and I'm on a 15-minute chart here. My execution is always going to be on the 15-minute chart. Okay, in this test. Because it's pretty good for the intraday, and it's also decent enough if you're trading off of the 4-hour. So, what did I do? So I started and I said, okay, I know nothing about the past, but I need to have levels here to work off of. So I identified 2 levels. I let the market trade until it formed these 2 levels. We had, a strong support that was then confirmed down here, and a strong resistance. Until these things were formed, I didn't do anything. Okay, and then what we did is we broke above this. So we're obviously still in the intraday camp. Okay, this is still happening on the 2nd of April, and we're just going from there. So we broke above this, the Asia top. Okay, so we came back down for the first test, and this is the key here. We're not trying to pick tops and bottoms. So I didn't buy this first test because I don't know whether this is going to be proven as a support or not. It was a resistance, but I want it to be proven as support before I actually risk any money on this level. Okay, and that's something that you'll notice in other examples. I actually took a couple of trades without waiting for the test, and they were losses. So it's it goes to show you need to wait for the market to actually show you that there were buyers there. So that's where I bought. This was the inside candle down here, and I'm buying. I was late. I was buying. I should have bought atop this inside candle. I bought a little later, but this is just a matter of pips. No big deal. Stop is just below the this candle. I usually put the stop below the actual zone. And I would discourage you from putting a stop, pip perfect at the level, etc., just in case the market wants to wiggle around. If you have another sort of swing zone, you can put it a couple of swings below to give it more room. But in any case, put it below the zone so you give the market a bit of wiggle room. So that's where I'm buying, and I don't know anything above here. I don't know what's going to happen. So I can just manage the trade based on the things I told you earlier. Reversal candles, loss of momentum, and we'll see what happens. So this is what happened. So the market rallied, okay, and it gave me basically a 2.5 to 1 up to the first scale out here. spinning top, market is losing momentum, and then we have a little pin bar here. So I scaled out there, part of the position. I brought my stop to par on the rest, and the market came back down and stopped me out. So partial profit on this first trade, not too bad as a start. And then what does the market do? The market starts to fall, okay? And it's going back down. So I didn't trade this level, okay, on the way down, because I wanted it to act again as resistance before I traded it. But it didn't really do that. The level sort of lost significance because we traded through it, and then we traded sort of above it and back. This is showing you the level is losing significance. But beyond that, the day was still positive, and then we had this negative shift in momentum. So I'm just holding fire because we've got sort of mixed information. Positive day, negative momentum. My thinking is we're either going to continue with the negative momentum, and I'll probably have like a break and retest of this level here, or the market will start to climb again, and we'll see what happens as levels are formed. At this point in time, as we were breaking through, we have a new high, okay, a new key level up here at the 23.45 level, I think. And then we had the day's low. So what happened is that we tried to rally towards the current day low, and we didn't reach it. Then we tested it. We tried to get at it again, and then formed the inside candle. So I actually sold after that inside candle in case the market didn't reach the zone. And my stop loss, as you can see, is quite wide. It's above the zone, just in case we try and probe and test towards it. Theoretically, if this holding pattern breaks, then the market's probably going to go back up. One other thing I'd like to highlight here is that this trade was during Europe. This trade is during late New York as we're heading into the rollover. So this in itself is a lower probability trade because liquidity is thinner. There's less interest in the market, and this is the quiet time. The better trades are always going to be during London or early New York, and I don't really trade on my own account after the London close. But for the purposes of this exercise, I did it anyway, just to see what happens. So I eventually had to take the loss on this trade. Okay, you can see sold it there, and the market actually did go back up to the level, and it broke through it. Okay, so this price action was not interesting to me because we're trading within the previous day's range, which means that your 50 moving average would be sidelined. It would be lateral. Okay, we need breaks and retests of usually previous days highs and lows on the very short term in order to continue with any directional momentum. So that's exactly what I did. I waited till the market actually broke through the previous day's low, okay, and finally went to retest it. And once again, this is an Asia trade, okay. I guess it's a bit better because it's not in the doldrums of the rollover. It's happening actually after Tokyo is open, and we also have Auckland in the mix as well. But we had a nice inside candle there, and for the sake of this test, I took the trade. This is how it progressed from my sale. The market actually went back down, but near the previous day's low, it posted this reversal candle, okay? It's sort of like a bullish engulfing. It's not a perfect bullish engulfing, I know that, but its body and its direction, it's visibly stronger than the candles on the way down. And so this is where I scale out of the trade and I protect myself, because we don't know what's going to happen, and I don't want to be holding a trade and hoping that it's going to work. So eventually what happened here is that the market went back up and stopped me on the rest, and it rallied, it chopped around during the day. Once again, I can't do anything around here because the market it hasn't broken above a previous day's high. It's not back down below this key level, this key zone that we were playing off of before. So I just had to remain still and not do anything. And then finally into the Asia session of April 5th, it broke down again. So clear break below the level. We have a retest of the level during Europe. So during a better time zone, and we have the inside candle. So I'm selling there. And this is what you really want to see. These are the best kind of trades, the trades that don't really stick around and they depart fairly quickly. So what I did is, after we broke through the Asia low, I scaled out a part of my trade, and I'm letting the rest run, to see what happens. So if I hadn't have scaled out here, of course I would have scaled out on the next candle, because this is a very strong stalling action, loss of momentum. Okay, so if I hadn't done it here, I would have done it here. Not a big difference, not a problem. The important thing is that we're following the rules. And let's see how it continues. Ideally, what you want to do is you do want to have trades like these that continue, and you don't want to close your entire position, because if the market is strong into the day's close, you want to hold it and see whether the market will actually produce a rollover trade and continue, and give you an extremely big risk to reward. This is just a momentary view of proceedings on the hourly chart up to now. Okay, so this is how we started. That was the initial level. That was the breakdown. That was a sale. This is on the second day, what was going on. Blah, blah, blah. We broke down. That's where I tried the second sale. Notice how the second sale was at the previous day's low, okay, which is also tested again. And that's where I had to scratch the trade. And then we broke down again through that same level, okay, that had been tested. And the level remains valid because we had, the low, the test, the break, the test, and then the level remained in play on the previous day. So that's why I kept the level on my chart, and I was trading at that level, okay. Then on this chart here, after we broke through these lows, of course, I have to update the level. Like I was saying before, you need to update your levels during the day. Okay, so you remain up to date with the levels that are being traded in the here now. So after seeing this on the hourly chart, we can go back to 15. And as the market was pulling back to that updated level during Asia, once again, for the purposes of this experiment, I sold there. And as we were approaching Europe, loss of momentum, okay, stalling action, so I'm scaling out of the trade. Stop loss is still up there, and we're still holding the trade from the previous day, okay? And what I did is I brought both those stop losses down above the current day's high. Okay, so we're in profit on the second trade, and this add-on trade here has been scaled out of, so we're doing pretty good. After the scale out, the market tanked again, and it reached the previous day's low. So at that point in time, I brought both those stop losses down. So we're running with risk-free trades on both of them, and this is a great situation to be in. And you're in a larger position now because you've added, scaled, and we're just using the same rules. After we protected our trade, we're just holding on to see what happens. So what happened here is, from the previous day's low, okay, the market actually posted a higher low and started to retrace. And so that's where I closed the add-on trade. Okay, this is the loss of momentum. And the second trade was closed at the stop loss. Okay. So that's how those two trades were actually closed. And what happened here, I suppose there was news, there was something that went on in the market, but there was a big shift in momentum. Okay, a big shift that took us above the key level, the most recent key level, okay, that was tested and it was rejected. And so what I'm doing is I am following this shift in momentum, and I'm buying this after this inside candle. So remember, it was tested here, and it was faked out here, inside candle, and I'm buying on the break of the inside candle. Once again, execution is a bit sloppy, but it's realistic. Okay, you're not going to get pip perfect entries in the market. So this kind of sort of sloppy execution you see with me, that's realistic execution. And my stop loss is back down here below the zone. So let's see what happens. This was my initial purchase. This is the hourly chart, so just to show you the kind of situation that we're in. Okay, this was the zone. It's quite evident. And the market has broken through it. And that's where I did my initial purchase. But what I want to show you is that there really is no rush to chase the market. You actually had better entries the following day as the market went back down to probe the zone. Okay? You know, during the same day, you don't need to be in a rush to sort of chase the market up. And I guess what motivated me to get in there as well was not just the fact that we're back above a level, so I'm actually using the techniques that I'm showing you, but also because there was evidently some news there that you know, that generated this strong shift in momentum. And so that's the additional sort of confidence booster I used when I took this trade. And but yeah, the next day, you know, honestly, these were better entries because you're pulling back to the level and it gives you, you know, keener risk. So you get a slightly larger position size, and the market is actually proving that the level is more robust, you know, and that you're actually finding buyers on the other side. So I took the riskier option, but there were better options on the next day. And if you hadn't traded this and the next day the thing fell through, you would have actually saved yourself from a loss. So that's why, you know, never be in a rush. I was able to scale out of this trade up here on the pin bar, and on the 15-minute, I'll show you what it was like on the 15-minute too. It was, you know, we're showing this loss of momentum up here. So, you know, no real, you know, appetite to continue holding the trade. Let's go forward. The new level was formed after that. After we get the previous day highs that were creating this nice flat surface here, nice resistance level, that as it breaks is expected to become support. So you can see the initial test here. Okay, you can see the break, the initial test. I'm not buying that. Okay, the fact that it acted as support is kind of nice. And what I like is I like the second test. So we're actually faking out these weak buyers here. We printed the inside candle, and I'm buying this because, you know, we did find buyers and we're at the key level, so we're going to see what happens. The market didn't get too far before it sort of conked out, and that's why I scaled out of the trade. Loss of momentum. The market's not really doing anything. We're, you know, quite a ways from the previous day's high, and instead of continuing with, you know, the large positive candles, we stalled. And so, as a precautionary measure, I cut part of the trade and just held the rest to see what's going on. The market fortunately continued, and it reached the previous day's high the next day, but then there was a stronger loss of momentum, so I cut the trade there. And that's that. You know, we don't know, you know, we didn't know what was going to happen over here. We didn't know the price was going to go up another 10 pips or whatever. Doesn't matter. You're following the rules. The market is stalling. It's showing, you know, a shift in momentum. These candles are starting to become stronger than the bullish candles on the way up. So you just protect yourself, cut the trade. There will always be another entry, another possibility. No worries there. I remained seated and didn't do anything for the next day because the market eventually came back down. Okay, and this is the first trade I'm actually attempting. As the market came back down below a key level, I'm actually trying to trade to the bottom side. So here you have the inside candles that were broken. That's my entry. And of course, it's an entry during, you know, the later part of the day, lower probability, and of course I had to scratch it. So as of right now, you know, in this test, I've had 2 trades that this is actually the 3rd trade taken during you know, late New York, early Asia, and I haven't really had great success on any of them. I actually had a loss on one of them and a scratch trade on this one, and a small profit on another one. But the entries that did produce the results happened during London or early New York. So just take note of that because it's kind of important. This was the wider view. Okay, what had happened, remember this was where I closed the previous trade. Okay, then the market actually showed some strong rejection from the top there. Came back down, broke through the previous day's low, tested it on the way down, and I am, sorry about that, and I am selling on the retest, but it didn't do anything. Market tested the level, went down, chopped around, and I'm not doing anything. Okay, remember, you're looking for clean test, you're looking for clean momentum, strong directional momentum. When the market's chopping around, just let it be. Let it go about its business and wait till it does something significant. So at this point in time, I'm seeing not just this level here, but I'm seeing that the other level has been produced with the test. So now I'm actually expecting this to become support. Okay, and as the market is starting to trade back above it. And this is what happens when you're asleep at the wheel. This is what happens when you're trading for a while and your concentration starts to fade. Because I've been doing all these trades and this test as if it were real-time trading. And so at this point, I guess I was mentally tired. And when I saw this, I was looking at this, I'm staring at it, and I see the market being rejected, etc. And at this point, I stopped, I took the screenshot, and I wrote, I was asleep at the wheel. Because the market went back down to test the key level, and I didn't do anything. But I guess this is what happens when this is real trading. This is what happens. I mean, even though I know the level's there, I guess I was so mentally drained that I didn't realize there was a trade there. The trade was on the break of these highs, so there was a decent trade there. This is what happened the next day. The next day we actually came back down through the level. Once again, I anticipated the break and retest of the level. I tried to pick a kind of top, and I was stopped out. So that's, once again, the lesson is to wait until the market tests it, goes a little ways, and then retests. And that's what happened here. This is the actual sell that you see here. This sell here is on the, it's an actual engulfing, not really inside, it's engulfing. But I'm selling this on those 15-minute chart because now that we're actually, now we're retesting it, we have a nice rejection candle there, and it looks a lot better than this. And so, decent trade. I'm holding it still, and the market just sort of continued on its way down for the next few days. Here we are, we're testing another key level again. So the same kind of setup there, rejection with this 15-minute candle. And that's where I scaled out. At the current day's low, we're seeing that kind of rejection, so stalling of momentum. And once again, that's where you scaled part of the trade, and the rest was cut at break even. This was the 4-hour chart of all those trades. So you can actually see the levels that I was trading at the time. And I think that's a wrap. So when I did this, when I went through all these trades here, I came out positive about 3%, risking 0.5% on each trade. So that's a 6-hour return in not even a month of trading. And as you noticed, I was basically just following momentum from one day to the next. I was, if you use the 50 moving average on your chart, the 50 simple moving average, you'll notice that all the trades were in line with the simple moving average. But I guess the takeaway is that even just by following a recent momentum and market dynamics in the past couple of days, and using these levels, and using a very simple entry, and using, because notice the entry is simple: one time frame, 50 minutes, one trigger, the inside candle, or an engulfing. I guess you could also put the engulfing in there as well. One management strategy, loss of momentum, or contrary price action, and you can get decent results. And I did this in real time. I had never downloaded or tried ForexTester before I tried this out for you, because I wanted to do something as realistic as possible. And these are the results. So I was pleasantly surprised as well. So here are the lessons. Okay, follow momentum. And this is something that we've talked about in all our previous webinars. You have to follow momentum because the market's current point of view on what the future looks like is embedded in the current direction. Okay, so you follow momentum, have an awareness of the prior day highs and lows, and this is the prior day's highs and lows. We saw them in action here, like we saw them on the hourly chart here. This is a prior day low, prior day high. This was a prior day high. Okay. Another chart up here, the hourly chart. Sorry, where is the other hourly chart? Here is the other hourly chart. Okay. So the first prior day low was where I was trying to trade the first time, actually over here. Then we had prior day low lows that were broken, tested. Okay. And then we had these prior day highs, which eventually acted as resistance. Okay, this sort of flat zone here, which is where the market traded down to. So these prior day highs and lows are important, and this is something that Linda Raschke said all the way back in the 1980s. And so certain things never change. The markets still view the same levels and trade in the same way as they always have. So the next thing is to look for the wick rejections on the hourly and the 4-hour to identify the key levels, the most important levels. And one of the takeaways, that I anticipated before this and that I demonstrated in this test is don't look too far back for your areas. Trade the areas as they are forming. Just look at yesterday, or if you're on a 4-hour, it could be last week for the most recent levels, if there aren't any fresh levels that have been created this week or yesterday. Okay, so trade the levels as they form, and then use well-established entry triggers. And we teach these in our free course or more in depth in the academy, and use a combination of techniques for the exit. Okay, but keep everything extremely simple, extremely systematic and consistent, so that if something is not working, you can identify exactly what's not working. But if you change your stance, if you change the rules from one trade to the next, you're never going to realize, what exactly works and what exactly doesn't work. Okay, it's like when I was riding a motorcycle years ago, I maintained the factory settings on my bike. And one day I was riding with a guy that was, theoretically, his bike was a CBR. I mean, it was a race bike, but he was, every time we stopped, he was always changing the stance. He was changing, the tension in different places of the bike. And I was like, what are you doing? And he was always trying to find, the perfect fit or whatever. But in the end, he wasn't a consistent rider. He really wasn't a consistent rider. And I've seen the same kind of behavior in the markets, where people just continue to sort of tweak and change, and they never really find any consistency or confidence, because they don't stick with something long enough to understand it. Okay, so that's something to keep in mind. The other thing is, and this is a chart that I've shown you time and time again, but it never gets old, and it's always important. You need to try and maintain your average wins, larger than your average losses. Okay, and slightly easier to do on the intraday frames, like when using the 1-hour in the intraday execution than using hourly or 4-hour execution. But you need to try and do it because you don't want to fret about losses. And the only way to not worry about losses is if your wins are taking care of your losses for you. I see so many traders have a negative skew strategy. So that's where they have, a lot of small wins, but they have these big losses that take up 3, 4, 5, 10 wins. That's not sustainable long term, because your trading strategy is only based on your win rate. And we don't want to see strategies based on win rates, because over time, win rates will always go down to 50% more or less, okay, over the longer term. You can have streaks, you can have statistical flukes, because even in random coin tosses, you will have trends. So you can have, times where you have an 80% win rate. It's fantastic. You feel like a genius. And you'll have times where you have a 30% win rate and you feel like a failure. That's why you need to remember that our brain looks for patterns even where there aren't any. Your profits and losses are actually random. Okay, it's only over larger sample sizes, over those 20, 30 trades at a time, where you will see your edge prevail. Okay, so keep that in mind, and keep in mind the fact that you get into a vicious circle if your losses are larger than your wins. So if you're scalping for small wins, you're under pressure because you have no room to lose. You need to be right. And that's not what I want to see. That's not what we want to see here at FCI Markets. I always encourage you to maintain, at least a 2-to-1 or 3-to-1, on your pre-identified trade, and let your trade management facilitate that for you. Scale out of your position when you see momentum starting to decline. Don't hold and hope. Okay, there will always be another trade. There will always be another situation. But yeah, try to maximize the gains on your trades, because you need that to keep your statistics profitable over time. So with that said and done, just before I open up the floor for some questions, I would suggest subscribing to our Thought Leadership blog. We send out our morning calls, analysis, blog posts. You can subscribe. You'll find this on news.fci-markets.co.uk. Again, if you want to go more in depth on the triggers and on the trade management that I used in my simulation here, just go onto our free course. You can download it, and eventually you'll get to those lessons where we explain exactly what I used in this situation. And finally, if you want to get onto the fast track for trader funding, and in order to become a professional trader, then come on to our academy. And we'll be working side by side. We have a combination of video courses, video lectures and interactive webinars to support you throughout the process. It lasts over a month, and at the end of that, you should be in a position to hit the ground running. And also, you can also sign up at FCI Ltd UK. These are our Twitter calls. We put out the most interesting charts, levels, and only the most influential market-moving news. And if you have any other questions, of course, just write us at client.support@fci-markets.co.uk. And we're happy to help.